Before we dive in, please remember that I am not a licensed insurance agent or financial advisor. This video is for educational and informational purposes only. The world of insurance is complex and highly regulated, with rules that vary significantly from state to state. Always consult with a qualified, licensed professional in your area before making any decisions about your coverage. Your financial safety is your responsibility. You're standing in front of your buddy's pickup truck. The keys are in your hand. He's letting you borrow it for the weekend to finally move that new couch and all those boxes into your apartment. It's a huge favor. But as you grab the door handle, a tiny nagging voice in the back of your head pipes up. Wait a minute. Am I actually insured to drive this thing? You pull out your phone, you Google one-day car insurance, and you immediately fall down a rabbit hole of confusion, dead ends, and sketchy-looking websites promising instant coverage for $20. You call a few big-name insurance companies, and the agent on the other end of the line either sounds confused or tells you flat out, "We don't do that." Sound familiar? So what is the real answer? Can you actually legally get car insurance for just one day in the United States? The answer is complicated. It's a yes, but that's wrapped in a no, not really. And in this video, we are going to be your definitive guide through this maze. We're not just going to tell you it's hard to find. We are going to show you the workarounds the pros use. We'll reveal the handful of specialty companies that actually exist, the legal loopholes you can use, and most importantly, the critical life-altering mistakes that could cost you everything you own. By the end of this presentation, you will have a complete playbook for any short-term driving situation you could ever imagine, whether you're borrowing a car for an hour, a day, or a week. Because let's be brutally honest, getting this wrong isn't an oops moment. Driving without proper insurance, even for a few miles to the grocery store, is like playing Russian roulette with your entire financial future. One wrong turn, one person who stops short in front of you, one small fender bender, and you're not just looking at a repair bill. You are staring down the barrel of potentially hundreds of thousands of dollars in medical bills, life-altering lawsuits, a suspended license, and a financial hole so deep you may never climb out. The National Safety Council estimates the average economic cost of a non-fatal disabling injury in a car crash is over $100,000. The average for a fatal crash? It's over $1.7 million. And if you're the one behind the wheel without the right coverage, that bill comes directly to you. Your savings, your home, your future wages, they can and will come for all of it. So why is this so difficult? Why can't you just buy a day of car insurance the same way you buy a cup of coffee? To find the solution, you first have to understand the problem from the insurance company's perspective. Their entire business model is built on managing risk over long periods. And a person who only needs insurance for a single day is by definition a massive blinking red light of risk. It's a concept called adverse selection. Think about it. Who needs insurance for just 24 hours? Someone moving heavy furniture in an unfamiliar truck. Someone test driving a car. Someone buying a car and driving it home from a private seller. Someone whose primary insurance policy just got canceled for non-payment. From an insurer's point of view, these are all high-risk, non-standard situations, far riskier than their ideal customer who commutes 10 miles a day in the same sedan for 10 years. Then there's the cost. The administrative work to set up a policy, to run your driving record, to verify your information, to process the payment, to generate the legal documents, is basically the same whether you're a customer for one day or for 1 year. For them to do all that work for a premium of, say, $30 is often a money-losing proposition with a gigantic potential downside. And on top of all that, the potential for fraud is enormous. It's a classic scam. A person gets into an accident at 2 p.m., then frantically goes online at 2:30 p.m. to buy a one-day policy, and then tries to file a claim saying the accident happened at 3 p.m. It's a logistical and financial nightmare for insurance carriers, which is why the vast majority of mainstream companies in the US, your GEICOs, your Progressives, your State Farms, your Allstates, have made a business decision to simply not offer a standalone one-day policy. They don't want the risk, the cost, or the headache. So they've made it nearly impossible to buy that product. But that does not mean you're out of options. Just means you have to get smarter. You have to know the other doors to knock on, the other tools that are available to you. And there are several powerful ones. The first and most common strategy you'll hear about is something called permissive use. This is probably the single most misunderstood concept in personal auto insurance. Then there's the non-owner policy, an incredible tool that most drivers have never even heard of. We'll also explore how you can strategically leverage rental car insurance policies, and the rise of pay-per-mile insurance and how it can be a brilliant, if unconventional, short-term solution. And yes, at the end, we will name the handful of specialty insurers that actually do cater to this niche market, what they offer, and what to watch out for. This isn't just a list. It's a strategy guide for financial self-defense. Let's start by dismantling the biggest myth of them all. The one you'll hear from every well-meaning friend or family member when you borrow their car: permissive use. Your buddy, the one with the pickup truck, probably waved his hand and said, "Don't worry about it, man, my insurance covers anyone I let drive my truck." And he's sort of right. Permissive use is a provision included in most standard auto insurance policies in the United States. It essentially extends the owner's coverage to someone who they have given explicit or implied permission to drive their vehicle. On the surface, it sounds like the perfect, simple solution. You borrow the truck, you're covered under his policy, end of story. Right? Wrong. Dangerously wrong. Relying solely on permissive use is like walking a tightrope 50 stories up without a safety net. It might get you to the other side, but if it fails, the consequences are catastrophic. Here's why you should think of permissive use as an absolute last resort, not a primary strategy. First, the coverage follows the car, not the driver. This is a critical distinction. This means if you get into an accident, it is your friend's insurance policy that is on the line. It's his claim history that gets tarnished. It's his premium that is going to skyrocket at renewal time, potentially for years to come. It's his policy that might get canceled entirely if the accident is severe enough. Are you really willing to put your friend's financial and insurance future in that much jeopardy just to move a couch? It's a huge burden to place on a friendship. Second, and this is the part that can bankrupt you, the limits of that coverage might be drastically lower for a permissive user. Your friend might be a responsible guy who has a great policy with $250,000 in liability coverage for himself and his family. But buried deep in the fine print of his 40-page policy document, there might be a clause, a step-down provision, that says any unlisted, permissive driver only gets the bare bones, state-mandated minimum coverage. Let's be clear about how terrifying that is. In a state like Florida, the minimum property damage liability is just $10,000. In California, the minimum for bodily injury is just $15,000 for one person. Think about that for a second. You cause a multi-car accident in his truck. The damage totals $40,000. The medical bills for just one person in the other car hit $50,000. Your friend's policy pays out the state minimums: $10,000 for the property and $15,000 for the injury. Who pays the remaining $65,000? You do, out of your own pocket. The other party's insurance company will sue you. They will get a judgment against you. They will garnish your wages for decades. They will put a lien on any property you own. Relying on permissive use is betting your entire financial life on the hope that your friend bought a platinum-level insurance policy with no weird exclusions, and that you don't get into a serious accident. It's a terrible, terrible bet to make. And it gets worse. What if you live with the person you're borrowing from? Let's say you're a college student home for the summer, driving your parents' car. In that case, permissive use almost certainly does not apply. Most policies have a named insured, or household resident clause, which means if you live in the same house and have regular access to the vehicle, you are required to be officially listed on the policy as a driver. If you're not, and you have an accident, the claim will be denied instantly. The insurance company won't just deny the claim. They might accuse your parents of misrepresentation or insurance fraud for not disclosing you as a regular driver in their household. So while permissive use is a real thing, it is a flimsy, unreliable safety net riddled with holes. It should never be your plan. It's what's there when there is no plan. So if that's not the answer, what is? What is the first proactive step you can take to get ironclad, reliable coverage for a short period? That brings us to the most underrated tool in the insurance world: the non-owner car insurance policy. It sounds almost too simple, doesn't it? A non-owner policy. The name itself feels a little strange. How can you insure something you don't have? But that's precisely the magic of it. A traditional auto policy is tied to a specific vehicle. It's built around the make, model, year, and VIN of your car. It insures the car, and by extension, the people permitted to drive it. A non-owner policy flips that script entirely. It doesn't insure a car at all. It insures you, the driver. It attaches to your driver's license, not a vehicle title. It follows you like a financial shadow, providing a crucial layer of protection whenever you get behind the wheel of a car you don't own. Think of it as liability coverage on the go. It's designed for a very specific and growing group of people. Maybe you're like Alex in New York City. He sold his car 2 years ago because the parking and insurance costs were astronomical. But once a month he rents a car to escape the city and hike upstate. Or maybe you're like Maria, a recent college grad whose car is still registered to her parents back home. She borrows it frequently, but she's not officially on their policy. A non-owner policy gives her her own, independent liability coverage, so if something happens, it doesn't automatically torpedo her parents' insurance rates. It's also a lifeline for people who frequently borrow a friend's truck for weekend projects, or for those who are in between vehicles. They've sold their old car and are waiting a month or two for their new one to be delivered. And here's a pro tip that most people never hear about. It is an absolute game changer for anyone who needs to file an State Route 22 or F44 form with the DMV to reinstate their license. These forms are proof of financial responsibility, and the state requires you to have insurance to get your license back. But what if you don't own a car? You can't get a standard policy. A non-owner policy satisfies that legal requirement, allowing you to get back on your feet legally. Without having to buy a car, you might not even be able to afford yet. So what does it actually cover? This is where we have to be incredibly clear. A non-owner policy is, at its core, a liability policy. That means it covers two things: bodily injury and property damage that you cause to other people. If you borrow your friend's Camry, run a red light, and hit a brand new BMW, your non-owner policy is designed to help pay for the repairs to that BMW and the medical bills of its driver. It is the shield that protects you from a potentially life-altering lawsuit. It is what keeps a bad day from turning into a decade of financial ruin. What it does not cover is just as important to understand. It does not cover the car you are driving. Let me say that again. It does not cover damage to the car you are driving. If you crash that borrowed Camry, a standard non-owner policy will not pay to fix it. It also typically doesn't cover your own injuries. It is an outward-facing shield, protecting the world from you financially speaking. It ensures that if you make a mistake, the other party is made whole. Now you might be thinking, okay, that's great, but how does this solve my one-day problem? These policies are sold in 6 or 12-month terms. And you're right. You can't call GEICO and buy a non-owner policy for 24 hours. But this is where we stop thinking like a consumer and start thinking like a strategist. The secret isn't about the duration of the policy. It's about the status it gives you. By purchasing a 6-month non-owner policy, you are fundamentally changing your relationship with the insurance industry. Insurance companies operate on risk assessment, and one of the biggest red flags for them is a gap in coverage. Someone who has been uninsured, even for a few months, is statistically more likely to be in an accident. Their rates skyrocket. By holding a non-owner policy, you are maintaining continuous insurance history. You are telling the entire system, I am a responsible, insured driver, even when I don't have a car in my driveway. This simple act can save you hundreds, even thousands of dollars down the line when you do decide to buy a car and need a traditional owner's policy. The ridiculously low cost of a non-owner policy, we're often talking $25, $30, maybe $40 a month, is an investment that pays for itself tenfold in future savings. So let's put this strategy into action. Let's talk about Mark. Mark just moved to Denver for a new job. He sold his car before he left, planning to use public transit. But his stuff is arriving on a freight truck, and he needs to rent a U-Haul for one single day to move everything from the depot to his new apartment. He goes online searching for one-day truck insurance. He finds a bunch of sketchy-looking websites with vague promises and no real company names behind them. He calls a few insurance brokers who tell him flat out they don't offer it, but they'd be happy to sell him a full 6-month commercial policy for $1,000. He's frustrated, stressed, and feels like he's being backed into a corner. Then he remembers a video he saw. He calls a major insurance carrier and asks for a non-owner policy quote. The agent on the phone is a little surprised. It's not a common request, but she runs his information. The price comes back, $32 a month for a 6-month term, a total of $192. For that price, he gets liability limits far higher than the state minimum. He buys the policy right there on the phone. The next Saturday, he walks into the U-Haul office with confidence. He knows he has his own high-quality liability insurance backing him up. He isn't reliant on whatever minimal, confusing coverage the rental company offers. He moves his stuff, returns the truck, and the day is a success. But the story doesn't end there. 2 months later, his college buddy flies in for a ski trip. His friend rented a car, but he's exhausted from the flight. Mark offers to drive the first leg up into the mountains. He can do it without a second thought because his non-owner policy is still active. It's his portable protection. He is covered. The one-time solution to his one-day problem has transformed into a 6-month safety net of freedom and peace of mind. Now, the biggest objection I hear is, why would I pay for 6 months when I only need 1 day? Let's break down the math. That 6-month policy cost Mark $192. If he had been in an accident without it, a lawsuit could have easily cost him $50,000 or more. The value proposition is off the charts. Furthermore, trying to get added to a friend's policy for a day is a nightmare. It's a hassle for your friend, it can raise their rates, and it puts all the risk on their insurance history, not yours. The non-owner policy is the clean, responsible, and adult way to handle the situation. It isolates the risk to the person who is actually driving. So now you have the foundation. With a non-owner policy, you have solved the massive, terrifying liability problem. You are legally protected from financially devastating lawsuits. If you cause an accident that hurts someone else or damages their property, you've built the concrete slab. But there is a huge gaping hole in this plan. What about the car? What about the $10,000, $20,000, or $50,000 machine that you are actually operating? If you borrow your brother-in-law's brand new Ford F-150 and you misjudge a turn, your non-owner policy will not pay a single penny to fix that crumpled fender. You are on the hook for the deductible, the repairs, and the potential destruction of a family relationship. So, you've protected the world from you. But how do you protect the actual car for just 1 day? That requires a completely different strategy, and it involves turning the tables on the very companies that make short-term coverage so difficult. To understand this strategy, you first have to understand why insurers are so terrified of selling you 1 day of physical damage coverage. It comes down to 2 concepts that are the stuff of nightmares for insurance executives: moral hazard and adverse selection. Sounds like jargon, but stick with me because this is the key to the entire kingdom. Moral hazard is just a fancy way of saying that when people are insured, they take more risks. If you have full coverage, you might park a little closer to that clumsy-looking pickup truck. But for one-day insurance, it's far more sinister. The biggest risk for an insurer isn't that you'll drive recklessly for a day. It's that you'll commit outright fraud. Think about it. What's to stop someone with a pre-existing dent in their bumper from buying a one-day policy, waiting 24 hours, and then claiming they just got into a fender bender? Or worse, getting into an accident at 10 a.m., frantically buying a policy on their phone at 10:15 a.m., and then lying to the claims adjuster about what time the crash happened? The potential for fraud is so massive, it's a financial black hole. Then there's adverse selection. This means the only people actively seeking out a super-specific product are the ones who are most likely to use it, and use it hard. Who needs car insurance for exactly 1 day? It's the person moving their prized, uninsured classic car across the state during a hailstorm. It's the person who's about to participate in a track day event, even though they know it's risky. It's the person who knows the route they're taking is notoriously dangerous. The pool of customers isn't a random sample of the driving public. It's a concentrated group of the highest risk drivers in the highest risk situations. For an insurance company which relies on spreading risk across a huge, diverse group of people, this is like a casino where only professional card counters are allowed to play. The house is guaranteed to lose. Combine the massive fraud potential with a customer base of only high-risk clients, and then add in the administrative cost of setting up a policy in the first place, which is the same for 1 day as it is for 6 months, and you can see why no sane company wants to offer this product. They would lose a catastrophic amount of money. So, how do you get them to sell you a product they don't want to sell? You don't. You buy the product they do want to sell, a standard 6-month auto insurance policy, and you use a consumer protection law to bend it to your will. This is the single most important strategy for getting 1 day of full coverage on a car. It's not a secret app. It's not a specialty company. It's a loophole baked into the very fabric of the insurance industry. Here's how it works: you buy a normal policy and then you cancel it. That's it. That's the core of the strategy. In almost every state, insurance regulators mandate that if a customer cancels their policy, the company must refund the unused portion of the premium. This is called a pro rata refund. They can't just keep your money for the 5 months and 29 days you didn't use. They are legally obligated to give it back. And they don't get to decide if you're worthy of the refund. It's the law. Let's walk through this step by step because the details are critical. Step 1. You shop for a standard 6-month auto insurance policy. You go online, you get quotes from all the major players. But you are looking for one very specific, crucial piece of information that most people ignore: the company's cancellation policy. You need to find a provider that has zero, and I mean zero cancellation fees. Some companies will charge you a flat fee, say $50 to close your account. Others will charge a percentage of your remaining premium. Either of these will ruin this strategy. You must find a company that will let you walk away for free. Step 2. You purchase the policy. You provide all your information, you set up the coverage you need, liability, comprehensive, collision, the works. You pay your first installment. This might be the first month's premium, or in some cases a 20% down payment. Let's say your 6-month premium is $900. You might pay $150 to get the policy started. As soon as that payment is processed, you are insured. You can download the insurance cards to your phone. You are 100% legal and fully covered. Step 3. You use the car for the day. You drive it to your nephew's graduation, you use it to move that giant armoire from your friend's apartment, you take it on that one-day road trip. If anything happens, a rock chips the windshield, someone dings you in a parking lot, or you get into a major accident, you are covered. You file a claim just like you would with any normal policy. Step 4. The very next day, or as soon as you are done with the car, you call the insurance company's customer service line and you say the magic words, "I'd like to cancel my policy, effective today." They might ask why. You can just say your circumstances have changed, or you sold the vehicle. You don't need to give them a long story. Step 5. You get your money back. This is where the magic happens. The insurance company will now perform a simple calculation. They will determine how much premium you earned for the one day you had coverage. Let's do the math on that $900 6-month policy. A 6-month period is about 182 days. So, $900 divided by 182 days is $4.94 per day. That was your cost. You paid them $150 to start the policy. They will subtract the $4.94 you owe them for that single day of coverage and refund you the difference. In this case, you would get a check or a direct deposit for $145.06. You just bought one day of full, comprehensive and collision car insurance, protecting a vehicle worth tens of thousands of dollars, for less than the price of a latte. This isn't a theory. This is a practical, legal, and powerful method that millions of people have used, often without even realizing it's a strategy. They just call it canceling a policy they no longer need. But what's the catch? There's always a catch, right? Yes, there are 3 major pitfalls you have to watch out for. The first, as we mentioned, are cancellation fees. They are the kryptonite to this whole plan. Companies like GEICO and Progressive have historically been known for having no-fee cancellation policies in many states, but this can change at any time and can vary by state law. You absolutely must read the fine print or call and ask an agent directly before you buy. If I cancel my policy, is there any fee or penalty? If the answer is anything other than no, you move on to the next company. The second pitfall is a sneaky little practice called short rating. Instead of a pro rata cancellation where you only pay for the exact days you used, some companies use a short rate table. This is a penalty disguised in complex math. The company basically says, because you canceled early, you have to pay a higher daily rate than you would have otherwise. So instead of charging you for one day's worth of premium, their special table might say they get to keep the first 10 days worth. It's their way of recouping some of the administrative costs of setting you up. It's still far cheaper than paying for a whole month, but it turns your $5 day of insurance into a $50 day of insurance. Again, you have to ask the company up front. Do you process cancellations on a pro rata basis or a short rate basis? If they say short rate, hang up. The third and most important catch is the burned bridge factor. You can't do this over and over again with the same company. Insurance companies use sophisticated software to track customer behavior. If you buy and cancel a policy every single month, you will be flagged in their system as an unprofitable, high-risk customer. It's like booking a flight, canceling it 23 hours later for a full refund, and doing it every week. The airline will eventually ban you. Do this once in a blue moon? Nobody will notice or care. It'll get lost in the sea of millions of policies being issued and canceled for legitimate reasons. But if you make it a habit, you risk being blacklisted. They might not be legally allowed to deny you insurance in the future, but they can certainly quote you an astronomical, "We don't want your business price." This is a powerful tool, but it's a scalpel, not a sledgehammer. So, the cancellation strategy is the undisputed champion for getting full coverage on a car for a single day. It leverages consumer protection laws to force a company's hand, giving you the exact product they would never willingly sell. It's cheap, it's legal, and it's effective. This covers you when you're borrowing or buying a car. But what about the flip side of that coin? What happens when someone needs to borrow your car for a day? You're certainly not going to cancel your own policy, and adding them as a driver, even for a day, can be a nightmare of paperwork and potential rate hikes. There has to be a better way to protect your own car and your own insurance record when you're the one doing the lending. And there is. It's a little-known type of policy that operates on a completely different premise, one that puts a digital wall around your own insurance, and it's probably already available on your phone right now. This is the world of peer-to-peer car sharing. Think of it like Airbnb but for your car. And the 800-pound gorilla in this space is a company called Turo. Now, you've probably heard of Turo as a way to rent a cool car for a weekend trip, something more interesting than the standard silver sedan you get from Hertz or Avis. And that's true. But what most people don't realize is that the real genius of Turo isn't the cars. It's the insurance. It's a completely separate, parallel insurance system built specifically for the short term. And it's the key to creating that digital wall we were talking about. Let's unpack this, because how it works is the solution to so many of these temporary insurance headaches. When you, as a car owner, list your vehicle on a platform like Turo, you have to choose a protection plan for yourself. This plan is provided by Turo through a major insurer like Liberty Mutual or Travelers. The moment a renter books your car and their trip begins, something almost magical happens. Your personal car insurance policy, your GEICO, your Progressive, your State Farm, is effectively put on pause. It becomes irrelevant. It is completely walled off from anything that happens during that rental. The primary insurance coverage is now Turo's commercial policy. This is a monumental difference from just handing your keys to a friend. If that renter gets into a catastrophic accident, totaling your car and causing hundreds of thousands of dollars in medical bills, the claim goes to Turo's insurance, not yours. Your personal policy's history remains untouched. Your premium doesn't skyrocket. That decade of safe driving you've built up isn't wiped out by one bad afternoon from your friend. The wall holds. So let's go back to our scenario. Your friend is flying in for the weekend and wants to borrow your car for a day trip. The old way was a handshake, a knot in your stomach, and a silent prayer that they don't get into a fender bender. The new way is completely different. Let's call your friend Alex. Before Alex arrives, you take 5 minutes and list your car on Turo. You can set the daily price to whatever you want. You could set it to $30 just to cover a car wash, or even the minimum possible price. You're not trying to run a business here. You're trying to leverage an insurance system. You then send the link to Alex and they book your car for the 24-hour period they need it. Now here's the crucial part for Alex, the borrower. As part of the booking process, Turo forces Alex to choose a protection plan. They cannot decline it. They cannot say, "Oh, my own insurance will cover it." They must buy one of Turo's plans for the duration of the rental. And this right here is the answer to the video's title. This is how you get car insurance for just one day. These plans come in different tiers, typically a minimum, a standard, and a premier plan. The minimum plan might come with a state minimum liability coverage and a high deductible, say $3,000 if they damage your car. The premier plan, on the other hand, will offer much higher liability limits, often up to $750,000, and it will have a $0 deductible. So if Alex chooses the premier plan and then proceeds to wreck your car, it costs them nothing out of pocket to get it fixed. And again, the claim goes against Turo's policy, not yours. You, the owner, have created a formal, insured commercial transaction out of a casual favor. You've replaced that flimsy, porous barrier of permissive use with a fortified steel and concrete wall of commercial insurance. For that 24-hour period, Alex isn't just a friend borrowing your car. They are a paying customer covered by a dedicated insurance policy that they purchased. Think about the clarity and peace of mind this provides for everyone. Alex knows exactly what their financial exposure is. It's not some vague "my insurance might cover it" situation. They know if they crash, their maximum out-of-pocket cost is their chosen deductible, $3,000, $500, or $0. It's all laid out in black and white before they even get the keys. And you, the owner, can hand over the keys with a genuine smile, not a forced one. You can actually enjoy your weekend knowing that your financial future isn't riding shotgun with your friend on the Pacific Coast Highway. Your insurance is safe. Your assets are protected. You've successfully isolated the risk. You've taken a massive, undefined personal liability and transformed it into a small, defined commercial transaction. This is a profound shift. It's using a modern platform not just for its intended purpose of renting to strangers, but as a sophisticated tool to manage risk among people you actually know and trust. It's the ultimate defensive move for any car owner. It's a way to be generous without being foolish. So, can you get car insurance for one day? Yes. By renting a car from a friend or a stranger on Turo, you are, by definition, purchasing a commercial auto policy that lasts for the exact duration of your trip, whether it's 24 hours or 72 hours. It's a self-contained, temporary policy. And for the owners, it's even better. It's a way to provide your car with its own temporary insurance policy that shields you from literally everything. It's the bulletproof vest for your personal auto insurance. This seems like the perfect answer, right? A clean, modern, app-based solution that protects both the lender and the borrower. And for this specific scenario, lending a car to a visiting friend or family member, it is, without a doubt, the single best way to do it. It's elegant, it's clear, and it's secure. But this is where we have to be careful, because this solution, as brilliant as it is, only works within its own little ecosystem. What happens when Turo isn't an option? What if the car you need to insure isn't your second car, but a car you just bought? Imagine a different scenario. You've just found your dream car, a classic 1995 Mazda Miata, on Craigslist. It's 300 miles away. You agree on a price with the seller, a guy named Gary. You take a bus, meet Gary at his house, hand him a cashier's check, and he hands you the keys and the title. The car is now legally yours, but it has no insurance on it. Gary's policy ceased to cover it the moment he signed the title over to you. And you can't add it to your own policy yet because you don't have all the paperwork finalized, and your insurance agent's office is closed for the weekend. You're standing on a stranger's driveway 300 miles from home, with a car that is completely uninsured. You can't use Turo. You can't list a car you just bought and then rent it to yourself. That's not how it works. So how do you legally and safely drive it home? That 300-mile journey is one of the most high-risk situations a driver can face. You are in a new unfamiliar car, on unfamiliar roads with absolutely zero coverage. One mistake, one blown tire, one person running a red light, could lead to financial ruin before you even get your new car into your own garage. This is a massive gap. The Turo solution doesn't apply. So what do? Is there an equivalent of Turo's on-demand insurance, but for a car you just purchased from a private seller? Is there an app you can tap to get an instant 24-hour policy to cover that one specific high-stakes drive home? The answer to that question reveals a whole different side of the temporary insurance market, one that's far less known and comes with its own set of critical warnings. These warnings center on a new breed of insurance that has exploded in popularity thanks to slick marketing and smartphone apps. On-demand or pay-per-mile insurance. On the surface, it sounds like the absolute perfect solution. The holy grail for our driver who just bought a car 3 states away and needs to get it home. The pitch is intoxicatingly simple. Why pay for insurance when your car is just sitting in the garage? With companies like Metromile or programs like Nationwide Smart Miles and Allstate's MileWise, you only pay for the miles you actually drive. You download an app, turn on the coverage when you start the engine, and turn it off when you arrive. For a single long drive home, it sounds like a custom-made, cost-effective miracle. You could, in theory, activate it for the 8-hour drive and then cancel, paying only for that specific window of use. It feels like the insurance industry finally caught up with the 21st century. This is the rabbit hole our hypothetical car buyer, let's call him David, dives down. He's standing in the dealership parking lot, the new car smell filling his nostrils, the keys feeling heavy in his hand. He's just been quoted a high price for a 6-month policy he doesn't need. He pulls out his phone and searches for one-day car insurance. The first results are gleaming ads for these pay-per-mile services. Only pay for what you use, one screams. Insurance by the mile, another proclaims. David feels a wave of relief. This is it. This is the modern digital solution the old guard insurance companies don't want you to know about. He downloads an app, ready to be on the road in minutes. But this is where the dream collides with a brutal bureaucratic reality. The first and most critical misunderstanding is that these are not one-day policies. They are not temporary insurance in the way you think. When you sign up for a pay-per-mile service, you are signing up for a continuous, ongoing insurance policy, typically on a monthly or 6-month term, just like with Progressive or GEICO. The only difference is the billing structure. Instead of a flat fee every month, your bill is composed of 2 parts: a low monthly base rate and a per-mile charge on top of that. Let's break that down, because it's the fine print that unravels the entire concept for David's situation. First, that base rate. You pay this fee every single month, even if you don't drive a single inch. It's not zero. This rate covers your car while it's parked, protecting it from things like theft, vandalism, or a tree falling on it. This comprehensive coverage is always active. So, the idea that you're paying nothing when you're not driving is a marketing fantasy. You're paying less, but you're still paying. For David, who plans to cancel after one drive, this might seem like a small detail, but it's the first crack in the facade. The second and much bigger problem is the activation process. The ads make it seem as instantaneous as ordering a pizza. Tap a button and you're insured. The reality is anything but. These companies are still full-fledged, regulated insurance providers. They have to do their due diligence. When David starts filling out the application on his phone, he's not just entering his name and credit card number. He's asked for his driver's license number, his driving history, the car's VIN, and a host of other details. He submits everything, expecting a confirmation screen. Instead, he gets a message that reads, "Thank you for your application. Our underwriting team is reviewing your information." This can take up to 48 hours. 48 hours. David's heart sinks. He's standing at a dealership that closes in 3 hours, in a city he needs to leave tonight. He doesn't have 48 hours. He has 48 minutes. This delay is the silent killer of the instant insurance dream. Underwriting is the process where the insurance company assesses your risk. They pull your motor vehicle report to check for accidents and tickets. They verify the vehicle's history. They run the numbers to decide if you're a profitable customer. This process is non-negotiable, and it is never, ever truly instant. While some automated systems can approve a squeaky clean record in a few hours, any slight hiccup, a recent move, a new vehicle model, a minor traffic violation from 3 years ago, can flag the application for manual review, extending the wait time to days. But let's say, by some miracle, David's application is approved in under an hour. He still faces another hurdle: the technology itself. Most pay-per-mile services require a telematics device. This is a small gadget that you plug into your car's OBD2 port. That's the onboard diagnostics port, usually located under the steering wheel. This device is what tracks your mileage accurately. The company mails this device to you after you're approved. The shipping alone takes several business days. So even if his policy is technically active, the core mechanism for billing him correctly won't arrive until long after he gets home. Some newer services can use your smartphone's GPS to track mileage, but this introduces its own problems. It drains your phone battery, it requires you to have the app running constantly while you drive, and its accuracy can be spotty. For David, fumbling around trying to find the OBD2 port on a car he's never driven before, or trying to set up a new app to track his every move, is a technical nightmare he wasn't expecting. And then comes the final crushing blow. After all that, after navigating the misleading marketing and the frustrating delays, David might hit the biggest wall of all: geographic availability. These revolutionary, tech-forward insurance companies have a very limited footprint. Pay-per-mile insurance is a relatively new product, and it has to be approved by each state's insurance commissioner. As of today, many of these services are only available in a handful of states. Metromile, one of the biggest names, only operates in 8. So, if David bought his car in Texas but he lives in New York, he might be fine. But if he bought it in Florida or Colorado or North Carolina, the app will simply give him an error message. "Sorry, we do not offer coverage in your state." All that time, all that hope wasted. David is back to square one. The promise of a quick, cheap, one-day solution, delivered with the slickness of a Silicon Valley startup, has completely evaporated. It was a mirage. Pay-per-mile insurance is a potentially great product for a very specific type of person. A low-mileage driver, living in the right state, who doesn't need insurance in a hurry, and is willing to let a company track their every move. But for someone needing immediate, temporary coverage for a single event, it's a dead end. It's not designed for that. It's a monthly subscription service with a clever billing system, masquerading as an on-demand utility. So now he's truly stuck. The modern app-based solution was a bust. The traditional insurance companies want to lock him into a 6-month contract. The dealership is offering him a binder, but the cost feels like extortion. Every obvious door has been slammed shut. It's in this moment of desperation that people start looking for the unofficial doors, the loopholes, the insurance hacks that get passed around on internet forums. What if he just adds the car to a friend's policy for a day? What if he buys a non-owner policy? These are the gray areas of the insurance world. filled with creative workarounds that are often misunderstood and incredibly risky. And exploring them reveals just how dangerous it can be to get the wrong kind of coverage, even for a single day. Let's start with one of the most common misconceptions: the non-owner car insurance policy. On the surface, it sounds perfect. It's insurance for someone who doesn't own a car but drives occasionally. You might be thinking, that's me. I don't own the car I want to drive for the day, so I'll just get a non-owner policy. Seems logical, almost elegant in its simplicity, but this is the first major trap. A non-owner policy is not a tool for a single day. It's a long-term product, typically sold in 6-month or 1-year terms, just like a standard policy. The insurance industry designed it for a very specific person. Someone who consistently borrows cars, uses car-sharing services frequently, or needs in State Route 22 to get their license back but doesn't own a vehicle. It's about establishing a pattern of coverage for a lifestyle, not flipping a switch for 24 hours. But the misunderstanding goes deeper, and this is where it gets dangerous. A non-owner policy is almost always secondary liability coverage. Let's break that down. When you borrow your friend's car, their insurance is the primary coverage. It's the first line of defense. Your non-owner policy is the backup quarterback. It only comes onto the field if the primary insurance gets completely wiped out. So if you cause an accident that results in $70,000 of damage, and your friend's policy has a $50,000 liability limit, your non-owner policy could potentially step in to cover the remaining $20,000. But here's the kicker. It provides zero coverage for the car you're actually driving. No que lichen, no comprehensive. If you wrap your friend's Honda Civic around a telephone pole, the non-owner policy will do nothing to fix or replace it. You are personally on the hook for the full value of that car. So, not only can you not buy it for a day, but even if you had one, it wouldn't solve the most immediate problem of protecting the vehicle itself. This leads people to another creative but deeply flawed idea. They think about rental cars. When you rent from Hertz or Avis, they offer you a loss damage waiver or LDW right at the counter. For a daily fee, you can walk away from a wreck without paying a dime for the car. So the logic follows. Why can't I just do that with my friend? I'll pay him $30 for the day, we'll write up a little agreement that says I'm covered, and boom, I've created my own one-day insurance. This is an incredibly tempting but hazardous path. A rental car company is a massive commercial entity with a fleet of thousands of vehicles and a multi-million-dollar commercial insurance policy backing them up. Their loss damage waiver isn't technically insurance. It's a contractual agreement from the company to waive its right to come after you for damage. Your friend, on the other hand, is just a person. He cannot legally sell you an insurance product. That piece of paper you both signed is, in the eyes of the law and the insurance industry, completely meaningless. If you get pulled over, that handwritten IOU won't satisfy the state's requirement for proof of insurance. And if you get in an accident, his actual insurance company will look at that agreement and toss it in the trash. The real mechanism that's supposed to handle this situation is something called permissive use. This is one of the most important and misunderstood clauses in every personal auto policy. In most cases, insurance follows the car, not the driver. This means if the car's owner gives you explicit permission to drive their vehicle, their insurance policy extends to cover you, just as if they were behind the wheel. For a simple, one-off scenario like borrowing a car to move a couch across town, permissive use is how it's supposed to work. No special policy needed. You're covered. End of story, right? Wrong. Relying on permissive use is like walking on a frozen lake in April. It might hold, but you better be damn sure before you put your weight on it. First, not all policies are created equal. Some cheaper, non-standard policies have what's called a named driver clause. This means the policy only covers the specific individuals listed on the declaration page. If your name isn't on that list, you have zero coverage. The car might as well be uninsured the moment you turn the key. The owner might not even be aware they have such a restrictive policy until after you've already crashed their car. But let's assume your friend has a standard policy with permissive use. The bigger risk isn't about you, it's about them. You are borrowing more than their car. You are borrowing their entire insurance record. If you have an accident, even a minor one, the claim goes on their policy. Their rates will almost certainly skyrocket for the next 3 to 5 years. A single at-fault accident can increase premiums by 40, 50, or even 80%, depending on the state and insurer. That free favor of borrowing their car for a day could end up costing your friend thousands of dollars in higher premiums. And if it's a serious accident, they could be non-renewed entirely. dropped by their insurer and forced to seek out expensive high-risk coverage. You are gambling with their financial stability. It is a massive friendship-ending level of risk that most people never even consider when they casually ask, "Hey, can I borrow your car?" And the danger escalates from there. What are the coverage limits on your friend's policy? Many people, trying to save money, only carry the state-required minimum liability coverage. In a state like California, that could be as low as $15,000 for bodily injury to one person and a measly $5,000 for property damage. $5,000? That barely covers the bumper on a new truck. Now imagine you make a mistake. You run a red light and T-bone a new Mercedes with a family inside. The medical bills are $100,000. The car is totaled. Your friend's insurance pays out its tiny limit in a heartbeat. And then what happens? The lawyers for the other driver don't just stop. They come after the car's owner, your friend, for the rest. And they come after you, the driver. Suddenly, you're both facing a lawsuit that could lead to garnished wages, liens on property, and financial ruin. All because you wanted to save a little time or money for a single day. Permissive use is a safety net, not a solution. Okay, so what about the tech-focused workarounds? We live in an age of usage-based insurance, or UBI. Companies like Metromile have you pay per mile. Others like Progressive Snapshot or State Farm's Drive Safe. And Save use telematics to reward good driving with lower premiums. Feels modern, flexible. It feels like you should be able to just turn it on for a day, right? But again, this is a fundamental misunderstanding of the product. These are still traditional 6-month or year-long insurance contracts. The billing method is flexible, but the underlying policy is not. You can't sign up for a pay-per-mile policy on a Tuesday to drive a car you just bought, and then cancel it on Wednesday after you've driven it home. The system isn't built for that. Opening and immediately closing a policy is a massive red flag for insurers. It can make it harder and more expensive for you to get insurance in the future. These programs are designed to more accurately price a long-term risk for a primary driver, not to provide on-demand, temporary coverage. So we've explored the gray areas. Non-owner policies, which are long-term and don't cover the car. Rental-style agreements, which are legally meaningless. The incredible gamble of permissive use, which puts the car's owner in a financially precarious position. And usage-based insurance, which is just a different way to pay for a traditional policy. Each of these workarounds is a dead end, a trap waiting to spring on the uninformed. They are all attempts to force a product designed for years of coverage into a 24-hour window, and it simply doesn't fit. The risks are too high, the gaps in coverage are too wide. This forces us to ask a crucial question. If all the traditional methods and creative workarounds fail, is there another way? What about the companies that have sprung up online? The ones that fill Google search results with promises of one-day car insurance and temporary coverage. Are they legitimate? Or are they just a new, more sophisticated version of the same old traps? We're now leaving the world of traditional insurance and entering the wild west of insurtech startups, where the rules are new and the promises are big. And we need to find out if they can actually deliver. So let's step into this digital Wild West. The first thing you'll find isn't a dusty saloon, but a slick, minimalist app on your phone. It promises to shatter the old insurance model. It's called pay-per-mile insurance. The concept is so beautifully simple, it feels like it has to be the answer. Companies like Metromile, which is now part of Lemonade, and even giants like Nationwide with their Smart Miles program, pioneered this. The pitch is irresistible. Why pay a fortune for a car that just sits in your driveway? Instead, you pay a low flat base rate each month and then a tiny amount, just a few cents, for every single mile you drive. Your brain immediately makes the leap. If I only need to drive 30 miles today to pick up a piece of furniture, I'll just pay for 30 miles. Sounds like the ultimate life hack. You envision activating your insurance, going for your drive, and paying a grand total of, $5 or $6 for the day. It's the dream. It's insurance on demand. But this is where the beautiful, simple dream collides with the concrete wall of reality. The first and most important catch is this: pay-per-mile is not temporary insurance. You are not signing up for a day or a week or a single trip. You are signing up for a standard, full-blown, 6-month or 1-year insurance policy. The only thing that changes is how your bill is calculated. You can't just turn it on and off. You are committed. So right out of the gate, the idea that this is a solution for a single day evaporates. You're still buying insurance for 182 days, you're just paying for it in a different way. Then there's the question of how they know how many miles you're driving. This isn't based on the honor system. They send you a small device, a telematics dongle, that you plug directly into your car's OBD2 port. That's the onboard diagnostics port, usually under your steering wheel. This little device tracks your mileage and beams it back to the insurance company. Or, in some cases, you use an app on your smartphone that does the same thing. Suddenly, this isn't just about insurance. It's about data. It's about privacy. There is now a direct, 24/7 data link between your car and your insurance company. For many, that's a feature. For others, it feels like putting a corporate chaperone in your passenger seat. But let's get back to the cost, because that's where the one-day illusion truly shatters. You don't just pay for the miles. Remember that low flat base rate? It's not zero. Let's say your base rate is $30 a month, and your per mile rate is 7 cents. If you don't drive your car for the entire month, 0 miles, you still owe $30. That means you're paying about $1 a day just for the privilege of being insured, even if the car never leaves your garage. So, for that one 30-mile trip you needed to make, you aren't just paying $2.10 for the miles. You're paying that plus the daily base rate. The cost is never just the miles. The marketing focuses on the cents per mile, but the engine of the business model is still the fixed monthly premium. It is a brilliant model for people who consistently drive very little over the course of 6 months. But for a one-day need, it's simply the wrong tool for the job. It's like buying an annual gym membership because you want to work out once. Okay, so the pay-per-mile startups aren't the answer. But the InsurTech world is creative. They came up with another, even more personalized model. This one isn't just about how much you drive, but how you drive. This is usage-based insurance, or UBI, and its biggest champion is a company called Root. Their premise is even more radical. They claim they only insure good drivers. The idea is that safe drivers shouldn't have to subsidize the premiums of reckless ones. And how do they find these good drivers? They make you audition. You download their app, and for the next 2 to 3 weeks, you go through what they call a test drive. The app runs in the background on your phone, using its sensors to monitor your every move behind the wheel. It's watching everything. Are you braking too hard? Accelerating too fast? Taking corners too sharply? Are you using your phone while driving? Are you driving late at night, a statistically riskier time? After a few weeks of this intense surveillance, their algorithm chews on all that data and spits out a verdict. If it deems you a good driver, it will offer you a quote. A quote they claim is fair because it's based on your actual behavior, not just your age, zip code, and credit score. This sounds futuristic. Sounds fair. But let's apply it to our original problem. You need car insurance for one day. The UBI model is, by its very nature, the polar opposite of what you need. You can't get insurance today. You can't even get a quote today. You have to spend weeks, sometimes a month, proving yourself to a piece of software before you can even have the option to buy a policy. The entire model is built on long-term data collection, making it structurally impossible to solve a short-term problem. And the privacy implications here are on a whole other level. It's not just a dongle counting miles anymore. It's your phone, an intensely personal device, tracking not just your driving habits, but your location, your speed, your patterns, your life. The algorithm that judges you is a complete black box. You don't know the exact weight it gives to one hard brake versus driving at 10 p.m. You could be an excellent driver who has to slam on the brakes once because a deer runs into the road, and that single event could negatively impact your score in a way you'll never understand. And here's the biggest risk of all. After you've given this company weeks of your intimate personal data, after this digital audition, they might just reject you. They can, and do, decide that based on their secret criteria, you are not the kind of driver they want to insure. So you get nothing. No quote. No policy. You've just handed over a detailed log of your life for free. It's a fascinating business model, and for the good drivers who pass the test and get a low rate, it can be fantastic. But it is fundamentally, unequivocally, not a solution for temporary car insurance. So what have we learned from this journey into the tech frontier? These innovative companies, with their slick apps and promises of fairness and flexibility, have certainly changed the conversation. They've tapped into a real frustration with the old rigid way of doing things. But they haven't solved the one-day insurance problem. In fact, they haven't even tried to. Their goal was never to create an on-demand product. Their goal was to reinvent the traditional 6-month policy for niche customers, the low-mileage driver or the statistically safe driver. They wrapped an old product in a new high-tech interface. They gave us a new way to pay, a new way to be judged, but the core product, a long-term contract, remains exactly the same. Feels like we're hitting a wall. The old guard of insurance is too big and inflexible to offer true temporary coverage. And the new disruptive startups are just building more sophisticated, data-driven versions of the same long-term model. It seems the answer simply doesn't exist. Has this entire quest been a fool's errand? Is one-day car insurance in the United States nothing more than a myth? A phantom that people search for online but can never actually find? But what if we've been looking at this all wrong? What if the entire problem is that we've been focused on the wrong thing? We've been trying to get temporary insurance for a person. But what if the secret isn't insuring the driver at all? What if the key is to insure the car, but only for the time you're using it? This shift in perspective opens up a whole new world of possibilities we haven't even touched yet. This is the world of usage-based insurance, and it completely changes the game. Instead of paying a flat fee for a month or 6 months, regardless of whether your car moves an inch or crosses 3 state lines, you pay for what you actually use. The most prominent player in this space is pay-per-mile insurance. Think of it like your electricity bill. You have a small monthly service fee just to be connected to the grid, but the bulk of your bill depends on how many lights you turn on and how long you run the air conditioner. Pay-per-mile insurance works on the exact same principle. You pay a low monthly base rate, which could be something like $30 or $40, and that covers your car while it's parked. It protects it from theft, vandalism, or a tree branch falling on it during a storm. Then for every mile you drive, you pay a few cents. We're talking maybe 5, 7, 10 cents per mile depending on your driving record, your car, and where you live. The insurance company tracks your mileage using a tiny device you plug into your car's OBD2 port. That's the same port your mechanic uses for diagnostics, or sometimes just through an app on your smartphone. So let's do the math. Imagine your base rate is $40 a month and your per mile rate is 7 cents. If you work from home and only use your car on weekends, maybe you drive 200 miles in a month. That's 200 times 7 cents, which is $14. Add that to your $40 base rate, and your total bill for the month is $54. That's a fraction of what a traditional policy might cost. But how does this get us to our one-day insurance solution? Well, what if you only drive the car 1 day a month? Let's say you have a classic car you only take to a car show, or a truck you only use for that one monthly trip to the hardware store. You drive 50 miles on that single day. Your cost for the month? $40 for the base rate, plus 50 miles times 7 cents, which is $3.50. Your total insurance cost for that month to cover that 1 day of driving is $43.50. Is it technically one-day insurance? No, you're covered for the entire month. But from a practical financial standpoint, you are effectively paying for that single day of use. You've found a loophole. You've aligned your costs directly with your usage. For the person who barely drives, this is revolutionary. It's the closest you can get to true on-demand insurance for a car you personally own. It acknowledges that a car sitting in a garage poses a fundamentally different, and much lower, risk than a car commuting in rush hour traffic every single day. The insurance industry is finally catching up to this reality, and it's saving savvy low-mileage drivers a fortune. But this solution, as great as it is, still assumes one critical thing: that you own the car. It's for the person with a vehicle sitting in their driveway. What if you don't own a car? What if you live in a dense city like New York or Chicago, where owning a car is a financial and logistical nightmare, but you just need one for a day to escape the city, move an apartment, or visit family? This brings us to the second, and perhaps even more direct solution: peer-to-peer car sharing. You've probably heard of the big names like Turo or Get Around. These platforms are essentially the Airbnb for cars. People who own cars list them for rent, and people who need cars can rent them for a day, a week, or even just a few hours. And baked into this entire ecosystem is a brilliant insurance model that is, for all intents and purposes, one-day car insurance. Here's how it works. When you, the renter, book a car on one of these platforms, you're not just paying for the car. A significant portion of that fee goes toward a commercial insurance policy that the platform provides. This policy is specifically designed for this exact situation. It covers you, the renter, for the entire duration of your rental period, and it supersedes the car owner's personal insurance policy. Let's break that down because it's crucial. The moment you pick up the keys and your rental period begins, a new, robust insurance policy springs into existence, covering you for liability, collision, and comprehensive damage. The moment you return the car and end the rental, that policy evaporates. It exists only for the time you are using the car. If you rent it for 24 hours, you have a 24-hour insurance policy. It is the literal definition of temporary, on-demand car insurance. You don't have to call an agent. You don't have to get a quote. You don't have to sign a 6-month contract. You just find a car you like, select an insurance protection plan offered by the platform. They usually have a few tiers, from minimum coverage to premium with a low deductible, and book it. The insurance is part of the package. So, if our goal is to find a way to be fully and legally insured to drive a car for a single day in the United States, this is arguably the most straightforward and accessible answer. You are paying a single fee to a company like Turo, and that fee includes both the use of the vehicle and the insurance to operate it for your chosen time frame. Now we have two incredibly powerful but very different modern solutions. On one hand, we have pay-per-mile insurance. This is the strategist choice for the car owner who drives infrequently. It's a long-term relationship with an insurer, but with costs that cleverly mimic a pay-as-you-go model. It requires owning a car and committing to a monthly base rate, but it gives you the freedom of having your own vehicle ready to go at a moment's notice, with costs that are directly tied to your low usage. On the other hand, we have peer-to-peer car sharing. This is the pragmatist choice for the car borrower who needs temporary access to a vehicle. It's a transactional solution. There's no monthly commitment, no ownership, no maintenance. You need a car for a day, you pay for a car for a day, and that payment includes the insurance for that day. It's clean, simple, and perfectly temporary. The path you choose depends entirely on your life. Are you the person with a second car that mostly collects dust? Pay-per-mile is your answer. Are you the city dweller who sold their car but still needs one for that occasional escape? Car sharing is your golden ticket. The old model of one-size-fits-all insurance is crumbling, replaced by these flexible, tech-driven options that are tailored to how we actually live and drive today. We've cracked the code on insuring a car you own but rarely use, and on insuring a car you don't own but need for a day. But this leaves one giant gaping hole. A scenario that is far more common than either of these. What happens when you don't want to rent a stranger's car from an app, and you don't own a second car yourself? What happens when you just want to borrow your friend's pickup truck to move a couch, or take your parents' minivan for a weekend trip? This is the world of permissive use. It's the most common form of short-term driving, and it operates in a gray area of assumptions and handshake agreements that could, in an instant, lead to financial ruin. Does your friend's insurance really cover you? What are the hidden limits and terrifying exceptions? The answer is far more complex and far more dangerous than almost anyone realizes. This is the single most common and most catastrophic misunderstanding in American auto insurance. It's a belief whispered between friends, a casual assumption made in driveways every single day. Don't worry, you're covered under my insurance. On the surface, it seems logical. The car is insured, so anyone driving it with permission should be insured too, right? This concept is called permissive use, and it's the bedrock of a financial fantasy that has financially crippled thousands of well-meaning people. Yes, in most cases, a standard auto policy does have a permissive use clause. It states that if you, the policyholder, give someone occasional permission to drive your car, your insurance will act as the primary coverage in an accident. And right there, in that simple sentence, are three explosive keywords that insurance companies use to deny claims and leave you, the borrower, holding a bill for hundreds of thousands of dollars. Occasional, permission, and primary coverage. Let's start with permission. What does that actually mean? You might think it's simple. Your friend hands you the keys and says, "Bring it back by dinner." That's explicit permission. But what if your roommate says, "Feel free to borrow my car whenever you need to run to the store"? Is that a blanket permission slip for any trip, anytime? What if you take it on a 3-hour road trip to visit family? The insurance company, desperate to avoid a massive payout, can argue that the scope of the permission was exceeded. They can interview your roommate, who under the pressure of a potential lawsuit and skyrocketing premiums might say, "Well, I only meant for short trips around town, not a long highway drive." Suddenly, permission is no longer a fact. It's a legal gray area. And in that gray area, your coverage vanishes. But the real trap, the one that snares countless drivers, is the word occasional. If you borrow your friend's car to help you move one Saturday, you're likely covered. But what if you start using it every Tuesday and Thursday to get to your part-time job because your car is in the shop? What if you use it a few times a month, every month, to pick up groceries? You are no longer an occasional user. You have become a regular, unlisted operator. And that is the kiss of death for a claim. Insurance companies base their rates on the risk of the people who regularly drive the vehicle. If you, with your own driving record and habits, are using the car frequently, but you're not listed on the policy and they're not collecting a premium for you, you represent an unknown, unpriced risk. In the event of an accident, they will deny the claim. It's not a possibility, it's a certainty. They will argue that the policyholder, your friend, committed a form of fraud called material misrepresentation by failing to add you as a regular driver. The result? The policy is voided for the accident, leaving both you and your friend completely exposed. Your friendship is over, and your financial life is in ruins. Now let's say you navigate those first two minefields. You had clear permission, and it was a truly one-time, occasional use. You're safe, right? Not even close. This is where we confront the most insidious secret of permissive use: the coverage drop-down. Many people don't read the fine print of their policy. Buried deep inside a multi-page document is often a clause that states while permissive users are covered, they are only covered up to the state's absolute minimum liability limits, regardless of how high the policyholder's own limits are. Let's play this out. Your friend is a responsible person. They have good liability coverage. $100,000 for bodily injury per person, $300,000 per accident. You borrow their SUV, you get into a serious accident, and the other driver's medical bills hit $100,000. You think, thank God my friend has good insurance. But the adjuster pulls up the policy and points to the fine print. For you, the permissive user, the coverage drops down to the state minimum. In many states, that's just $25,000. So, of the $100,000 in medical bills you caused, the insurance pays $25,000. You personally are now on the hook for the remaining $75,000, plus legal fees, plus the cost of the other person's totaled car. Your friend's good insurance just became a $75,000 liability for you. This happens every single day. People borrow a car assuming they're wrapped in a warm blanket of high-limit coverage, when in reality, they're protected by a piece of tissue paper against a financial hurricane. And it gets even worse. What if your friend, trying to save money, specifically excluded a driver from their policy? Maybe they have a roommate or a child with a bad driving record, and the only way to get an affordable rate was to sign a form that explicitly names that person and states they will never, under any circumstances, be covered while driving the car. If you are that person, or if you let that excluded person drive the car you borrowed, there is zero coverage. Not minimum limits. Nothing. It's the same as driving a completely uninsured vehicle, but the risk doesn't just fall on you, the driver. Puts the car owner in a terrible position. If you cause an accident that exceeds their policy limits, or the drop-down minimum limits, the injured party won't just sue you. They will sue your friend, the owner of the car. The lawsuit will likely be based on negligent entrustment, arguing that your friend was negligent in loaning their vehicle to someone who then caused a major accident. Now your one mistake has dragged your friend into a legal battle that could cost them their savings, their home, and everything they've worked for. Okay, you might be thinking, but I have my own car insurance. Won't that protect me? Yes, it might. If you have your own auto policy, it typically acts as secondary coverage when you're driving someone else's car. This means after the car owner's insurance pays out its limit, whether it's their full policy limit or the pathetic state minimum, your insurance can step in to cover the rest, up to your own limits. This is a crucial safety net. But what if your limits aren't high enough? What if the accident is a multi-car pileup with $500,000 in damages? And what if you're one of the millions of Americans who doesn't own a car, and therefore has no personal auto insurance policy? For you, there is no secondary coverage. There is no backstop. Your friend's insurance is your only hope, and as we've just seen, it is a hope built on a foundation of sand, riddled with exceptions, exclusions, and drop-down clauses designed to protect the insurance company, not you. The simple, friendly act of borrowing a car transforms you into an amateur lawyer, forced to gamble on the definitions of permission and occasional, and betting your entire financial future on the hidden text within a policy you've never even read. This entire system, this web of permissive use and secondary coverage, is precisely why the search for simple one-day insurance is so desperate. People instinctively know that borrowing a car feels risky, even if they can't articulate exactly why. They are sensing the truth, that these informal agreements are not a substitute for real concrete coverage that is in your name and designed for your specific needs. So, if the common solutions are a myth, where does that leave us? Is there any legitimate way to get insured for a single day, to cut through this complexity and drive with actual peace of mind? The final definitive answer is coming. The final answer is both simpler and more complex than you might imagine. In the United States, the product you're searching for, a standalone one-day car insurance policy that you can buy online in 5 minutes for a stranger's car, is, for all intents and purposes, a myth. It does not exist in the mainstream market. The insurance giants like GEICO, Progressive, and State Farm do not offer it. The regulatory hurdles, the immense risk of fraud, and the fundamental business model of assessing long-term risk make it a non-starter. So, have you wasted your time listening to all of this? Absolutely not. Because the product may be a myth, but the solution is very real. You just have to know where to look and what to ask for. The secret isn't finding a mythical policy. It's understanding the legitimate, alternative tools that achieve the exact same goal, getting you legally and safely insured for a very short period. Let's start with the most powerful and misunderstood tool in the short-term insurance arsenal: the non-owner car insurance policy. This is the closest thing to a magic key for people who drive but don't own a car. Think about it. Maybe you live in a city and use public transit but borrow your friend's car once a month. Maybe you're between cars, having sold your old one before the new one arrives. Or maybe you frequently rent vehicles and want your own liability coverage that follows you, not the car. A non-owner policy is exactly what it sounds like. It's a liability policy that's attached to you, the driver, not to a specific vehicle. It provides bodily injury and property damage liability coverage whenever you get behind the wheel of a car you don't own. Crucially, it acts as secondary coverage. This means if you borrow your friend's car and get into an accident, their insurance is still primary. Pays out first. But what if the damages exceed your friend's policy limits? What if a small fender bender turns into a massive lawsuit? That's where your non-owner policy kicks in, acting as a critical safety net, protecting your personal assets from being wiped out. And here's the kicker. While you can't buy it for just one day, you can often buy it on a monthly or 6-month basis for a surprisingly low cost, sometimes as little as $20 or $30 a month. You can then cancel it when you no longer need it. So for the price of a few cups of coffee, you can have peace of mind for an entire month's worth of occasional driving. It's not one-day insurance. It's any day you needed insurance, which is arguably even better. Now, what about the most common short-term driving scenario of all? Renting a car. This is the one place where you can buy insurance on a daily basis right there at the counter. But it's a minefield of acronyms and high-pressure sales tactics. Let's demystify it. The main product they'll push is the Loss Damage Waiver, or LDW, sometimes called a Collision Damage Waiver or CDW. This isn't technically insurance, but it functions like it. It's an agreement that the rental company waives its right to come after you for any damage to their car. You could total the vehicle, and as long as you didn't violate the rental agreement, you walk away clean. Then there's supplemental liability insurance. This is the one that protects you from lawsuits if you injure someone or damage their property. Your personal auto policy, if you have one, might already cover this, but this supplemental policy boosts those limits, often up to $1 million. Finally, there's personal accident insurance, which covers medical bills for you and your passengers, and personal effects coverage, which insures the stuff you have inside the car. The key here is preparation. Before you ever step up to that rental counter, you need to do 2 things. First, call your own auto insurance provider. Ask them explicitly, does my policy extend to rental cars, and what are my coverage limits? Second, call your credit card company. Many premium credit cards offer rental car insurance as a perk, but it's almost always secondary coverage and often excludes liability. Knowing exactly what you already have prevents you from overpaying for redundant coverage at the counter. But what if you do own a car, but you barely drive it? You need it for a grocery run one day, a doctor's appointment the next, and then it sits for 3 weeks. Paying a massive flat-rate premium feels like a total ripoff. This is where the third, and perhaps most innovative solution comes in: pay-per-mile insurance. This is the future, and it's already here. Companies like Metromile and programs from major insurers like Nationwide Smart Miles are disrupting the old model. Here's how it works. You pay a low flat monthly base rate, which keeps your car legally insured even when it's just sitting in the driveway. Then you pay a few cents for every single mile you drive. A small device plugs into your car's diagnostic port, or a mobile app tracks your mileage. If you drive a lot one month, your bill goes up. If you don't drive at all, you just pay the low base rate. This isn't one-day insurance. It's pay-for-the-day-you-drive insurance. It aligns your costs directly with your usage. For the remote worker, the retiree, the city dweller with a weekend car, this model can slash insurance bills in half. It's the ultimate solution for the low-mileage driver who needs full coverage, but only wants to pay for what they actually use. It offers the flexibility of short-term costs without the impossibility of a short-term policy. Finally, there's a very specific commercial example that proves the concept of temporary insurance is possible. Rideshare insurance. When a driver for Uber or Lyft turns on their app, a special insurance policy kicks in, covering them while they're waiting for a ride request. Once they accept a ride and have a passenger, an even more robust $1 million liability policy activates. When they turn the app off, that coverage ceases. This is a dynamic, use-based insurance model built for the gig economy. While you can't buy this for your personal use, it shows that the industry can innovate when a massive new market demands it. It's just that the market for personal one-day insurance for the general public isn't big enough or safe enough for them to have built a solution yet. So why? Why is this so difficult in the United States when it's common in other parts of the world? It boils down to a patchwork of 50 different state regulations, a deep-seated industry aversion to high-risk, short-term clients, who are statistically more likely to file a claim, and a business model built on the predictability of long-term relationships. Insurers make money by pooling the risk of millions of drivers over long periods. A one-day policy throws a grenade into that calculated actuarial model. It's all risk, no relationship. So we've come full circle. We started with a simple question and discovered a complex reality. We busted the myths of the quick-fix websites and the standard policy loopholes. We uncovered the real, legitimate strategies. The flexibility of a non-owner policy, the on-demand coverage at the rental counter, and the cost-saving genius of pay-per-mile. The ultimate lesson is this: the quest for one-day car insurance isn't about finding a secret product. It's about becoming a smarter consumer. It's about shifting your thinking from, how can I buy a one-day policy, to what is the right insurance tool for this specific, short-term situation. Before you borrow, before you rent, before you drive anything you don't own, you now know to ask the right questions. Whose policy is primary? What are the liability limits? Do I have my own non-owner policy as a backup? Is my credit card coverage enough? Answering these questions before you turn the key is the difference between a carefree drive and a life-altering financial disaster. You are now armed with the knowledge to navigate this system, to protect yourself, your friends, and your future. You didn't find a shortcut. You found something far more valuable: the entire map. Now I want to hear from you. What's the most confusing or stressful short-term driving situation you've ever found yourself in? Borrowing a U-Haul to move across the country? Test driving a car from a private seller? Share your story in the comments below. Your experience could be the exact lesson someone else needs to hear. Let's build a community of smarter drivers right here.